Hi everyone, my name is Nogotemba. You are more than welcome to be here. Make yourself comfortable and feel at home. For statement of financial position, we are going to use the same information. We are doing required number 2. Here we are required to prepare the statement of financial position as at 31st December 2015. We will be looking here on the trial balance in conjunction with additional information. The very first thing you do, you write down the name of the company and state which year are you preparing for. As usual, we start with assets. Assets are divided into two. We have non-current assets. We then have current assets. You always start with non-current assets, the fixed assets. Here we have furniture and equipment with a cost price of 260,000. Remember, I told you fixed assets are shown at carrying amount. In this case, we are not provided with accumulated depreciation, no depreciation, not even an information on how to calculate depreciation, but we still need to show carrying amount here. To calculate carrying amount, we say cost price minus accumulated depreciation equal to carrying amount. We have a cost price of 260,000 minus accumulated depreciation of 0. 260 minus 0, we have a carrying amount of 260,000. In most cases, this always happens on the first day of having an asset. You have an asset, but you haven't used it. In that case, cost price is always equal to carrying amount. Here we also have motor vehicles. We do the same thing as well. Cost price of 375,000 minus accumulated depreciation of 0. We have a carrying amount of 375,000. You write it down. Okay, we only have these two: property, plant and equipment assets. You then check for financial assets. You always check for investment. As you can see here, we have investment, the fixed deposit. Whenever you are provided with investment, make sure you check for its maturity date. That will help you to identify whether it is a long-term investment or a short-term investment. That one is very important. So here we have investment of 126,000. We are not given any date here. Let us go check on the additional information. Here, the fixed deposit investment was made on the 1st of May 2015 and earns an interest of 10% per annum. The interest on this investment is received quarterly in arrears on the 1st of August, on the 1st of November, on the 1st of February and 1st of May. Here again, we are not told when does it matures. In a case like this, the assumption is always a long-term investment. So write down investment 126,000 under non-current assets. Done. Let us total this: 260,000 plus 375,000 plus 126,000. We have total non-current assets of 761,000. You write it down. After non-current assets, we then move to current assets. Here we have trade receivables of 202,300. On the additional information, we are told a sales invoice for 20,000 relating to computers costing 10,000 sold to UTC on 31st December 2015 had not been recorded. Here we have credit sales. We made credit sales of 20,000. So how do we know this is a credit sales? Look here, we have a sales invoice. The key word here is invoice. Well, invoice, it is the document used to notify the customer that the payment is due. It also serves as the record for the issuing company that they can use to track their receivables. An invoice is issued to a debtor who owes us, which states the list of goods and services that we provided as well as the amount due. So here our debtor owes us 20,000. So you say plus 20,000. Our debtors control our trade receivables is now increasing. Okay, besides this information, nothing else affects our debtors. We have 202,300 plus 20,000. In total, we have 222,300. You write it down. We then have cash at bank of 181,100. No information on this, so write down bank 181,100. Here on the trial balance, no any other current assets. So let us go and check additional information. Okay, we are told stationery on hand on 31st December 2015 amounted to 7,400. So you write down stationery on hand 7,400. Next, a telephone bill for 4,000 for the month of December 2015 was received on the 4th of January 2016. Okay, skip this. This is an accrued expense. We have used this one. Next, the prepaid insurance of 115,200, the one on the trial balance, includes an amount of 72,000. This amount was paid 31st August 2015 for a period from 1 September 2015 to 31st August 2016. This amount, 72,000, has already paid. What we need to do is to remove the months which does not belong to this financial period, amounts which were not supposed to be here. Okay, what are those amounts? From September to August 2016, this is a 12-month period. So now let us see how much is the insurance premium per month in this 72,000. 72,000 divided by 12. Per month insurance premium is 6,000. How many months that we were supposed to pay? We were supposed to pay for September, October, November, and December. Only these 4 months were supposed to be paid. The rest has been paid in advance. 12 minus 4, we paid 8 months extra. So you say 6,000 times 8, 48,000 has been paid extra. It has been paid in advance. So write down prepaid insurance or prepaid expense of 48,000. Here we are told the fixed deposit investment was made on the 1st of May 2015 and earns an interest of 10% per annum. Interest on this investment is received quarterly in arrears on 1 August, on 1 November, on 1 February, and 1 May. So we are going to receive this interest income in arrears. So basically this means every 4th month we receive interest income. Money will be received late after 3 months has already passed. This is what they mean by in arrears. So what we know here, we made a fixed deposit during the year. Clearly, this amount won't be 12 months. It won't be an annual income. This amount will need to be apportioned by months. Remember, this deposit was made during the year in May. So we have May, June, July, August, September, October, November, and December. This is 8 months. So you say times 8 divided by 12. So interest income expected for this current period is 8,400. So here on the trade balance, we have a fixed deposit of 126,000. We then have interest rates of 10%. You say 126,000 times 10%. We have an annual interest income of 12,600. So remember, we have 4 quarters in a year. Each quarter has 3 months. Okay, so here we have interest income of 12,600 divided by 4. Per quarter, interest income is 3,150. The first quarter was received on the 1st of August, which covers May, June, and July, 3,150. The second quarter was received on the 1st of November, which covered August, September, and October, 3,150. So far, we have received only 2 quarters. If you say 3,150 times 2, so far we have received interest income of 6,300, which is the one on the trial balance. So the third quarter is going to be paid next year on the 1st of February. This would cover November, December, and January. But here we don't need January. January is out of our financial period. So you take this 3,150 divided by 3. Per month interest income is 1,050. Remember, November and December are accrued. 2,100 is accrued since it is going to be paid in next year, February. So this amount is accrued. You write down accrued income, 2,100. Okay. We have closing inventory of 335,000. Write it down. Done with current assets. Let us total this as well. 222,300 plus 181,100 plus 7,400 plus 48,000 plus 2,100 plus 335,000. We have total current assets of 795,900. Write it down. You then say 761,000 plus 795,900 we have total assets of 1,556,900. You write it down. Equity and liabilities section, we always start with equity. Under equity, we have capital. Write down capital, 472,200. We have retained earnings. Write down retained earnings, 385,300. We have drawings. You say less drawings of 54,700. We then have net profit for the year. This one is from the income statement video I made before this one. We have net profit of 290,900. Write it down. Done with equity as well. Let us give totals. 472,200 plus 385,300 minus 54,700 plus 290,900. In total, we have equity of 1,093,700. You write it down. Now we are doing liabilities. Again, liabilities are divided into two. We have non-current liabilities. We then have current liabilities. We always start with non-current liabilities. Here we have a bank loan of 240,000. You write it down. Only this long-term liability we have here. So total your non-current liabilities, 240,000. We then move to current liabilities. Here on the trade balance, we have trade payables of 186,600. No information was provided regarding this. So you write down trade payables, 186,600. Remember here, we received 23,000 in advance. So you write down income received in advance, 23,000. So here we have accrued telephone expense of 4,000. You write down accrued telephone 4,000. On 30 September 2015, a payment of 80,000 was made to repay part of 12% bank loan. When was this happened? 30 September. Keep that in mind. They then say interest on loan is payable half yearly in arrears. We are going to pay 31st March and 30 September. By half yearly, it means we are going to have two payments, 6 months, 6 months. Here we are told this interest is paid in arrears. So this means we are going to pay on the 7th month after 6 months has already passed. Okay. Remember, this loan was taken last year. So that means the interest payment we made on the 31st of March was covering 6 months from 1 September last year to 28 February 2015. We taken a bank loan of 320,000 with an interest rate of 12%. If you say 320 times 12, we have an annual interest of 38,400. Remember, it is paid half yearly, so divide by 2. 6 months is 19,200. 31st March, we paid 19,200. Remember, we had interest expense of last year which accrues to this current period. So this does not belong to this financial period. We need to remove it. If you say 19,200 minus this accrued expense of 9,600, we are remained by interest expense for this current period of 9,600. We then paid the other 19,200 in full. If you add this to 9,600 plus 19,200, we paid 28,800. This amount is this one here on the trial balance. This is how they calculated it. Okay, so this last payment we made on 30 September covers 6 months from 1 March 2015 to 30 August 2016. September, October, November, and December. These 4 are not paid. They will be paid next year again in March, which makes them an accrued expense. So remember, end of September, we made a loan repayment of 80,000. So now the interest expense will be calculated on the outstanding loan balance. If you say 320,000 minus 80,000, the outstanding loan balance is 240. This one you see here on the trial balance. To calculate interest payable, we are going to use 240 times 12%. We have interest expense of 28,800. So remember, now 6 months has already passed. So we are going to say 6 divided by 12. We have interest expense of 14,400. If you say divide by 6 months, per month interest expense is 2,400. Remember, we have 4 months accrued, so you say times 4. 9,600 is an accrued expense. So you write down accrued expense 9,600. 186,600 plus 23,000 plus 4,000 plus 9,600. In total, we have current liabilities of 223,200. You write it down. You then say 1,093,700 plus 240,000 plus 223,200. We have total equity and liabilities of 1,556,900, which is exactly the same as total assets. In this way, our statement of financial position is balanced. Thank you so much for watching. Till next time, Tululu.